So I am absolutely thrilled to welcome all of you to this webinar. This is a topic that has come up over dinner tables and in the boardrooms and at cocktail parties. And there's some misinformation and some fear about what is going to happen. And I think our panelists today are going to dissect this and tell us about how it can not be a problem or how we can manage it. A couple of housekeeping notes. If you have questions, we're going to take them at the end after Tina has interviewed Ali. So please put them in the Q&A section. The chat is disabled for this talk. So do put your questions in as you think of them or at the end. And my biggest tip is to have a pen and paper with you, because I know you're going to want to write things down as you hear. So I'd like to really warmly thank our two panelists today. Alexandra Ali Spinner is a partner in Crow Soberman's tax group, and she's a member of the firm's management committee and the leader of the high net worth tax practice. So her practice focuses on helping wealthy families and high performance professionals structure their affairs in such a way that they are tax efficient. She brings so much passion and warmth, and she's so eloquent. So she has deep relationships with her clients. I'm not going to go deeply into her accomplishments, which are many. You can see her credentials on the invitation, but I think it is worth pointing out that after 20 years in public accounting and tax and estate planning, she was elected as a fellow of the Chartered Professional Accountants of Ontario just last year in 2022. And that is a very high honor, as many of you would know. Tina is someone I do know very well also. Tina is dedicated to philanthropic clients and charities. She's been a wealth advisor since 1991. She started when she was 10, and she is an FP Canada Fellow, Financial Planning Fellow. She has been interviewed and quoted by the Globe and Mail, the Toronto Star, BNN Bloomberg, and regularly writes and contributes to these media outlets, as well as others like the Wall Street Journal, the National Post, and the CBC. She's granted many, many awards. I'm not going to go through them, or we would not have time for the actual presentation. But she is a good, kind friend to the Princess Margaret, who she's supported for a long time. And she is an expert in devising charitable tax planning strategies, helping charitably minded Canadians to multiply their impact on charities while reducing their taxes and leaving greater inheritances for their beneficiaries through their wills. So you're in excellent hands today. And I'm going to turn this over to Tina, who will host our session and grill Ali about what we all need to know.
Thank you very much for the introduction, Jill, and welcome to all of you. Thank you for joining us today. Ali, it's a pleasure to be talking with you today about this topic. As Jill mentioned, there's been lots of anxiety about what the changes to the alternative minimum tax rules mean and what sort of impact they're going to have on charities and charitable donations. So, Ali, could you tell us in a nutshell what is the alternative minimum tax and what are the changes that were proposed in the 2023 budget and would take effect as of January 1st, 2024?
Sure, Tina, that's a great question. And I appreciate maybe what I think I'm going to start with, just to even go back a little bit to address the concern. So the good news is that, well, I should say that we do not want to say, and we're not here to be alarmist, and we're not here to say to stop making charitable donations. That is absolutely not the case. It's very important for donors in Canada to continue to fund organizations like Princess Margaret, It does mean that perhaps in 2024 and forward, the donations that we make may not be quite as tax efficient as they were in 2023 and past, but we definitely don't want those donations to stop. There are still many, many tax benefits to donating. And truthfully, for most Canadians, probably 99.5% of Canadians, if I had to make a guess, they will not be affected by these changes in the rules. So I think I'll start with that, just to make sure that we take away the alarmist aspect, because you and I are not here to be alarmist for sure. So what is alternative minimum tax? So effectively, it's something that's been around for almost 40 years. It's been around since 1986, and it's something written into the tax code to make sure that all Canadians pay, really, just as it says, a minimum level of tax. When we prepare our tax returns, we prepare the normal computation. We include our income, we take our deductions, we claim credits for certain things, such as charitable contributions and other credits. And out pops a number that says, this is the amount of tax that we owe for a certain year. That's the routine, normal, typical income tax. What's also happening behind the scenes is there's this parallel calculation of an alternative calculation, which effectively, it computes income differently. So it looks at different sources of income and includes them in a base in a different way than the routine way. There's also a different rate that gets applied to this minimum tax world. And out at the bottom pops an alternative tax number. And effectively, so again, this is not new, but what would happen is that the program that you would use to prepare your taxes would look at, well, what's your regular traditional income tax? Let's say it's $100. And then it would look at your alternative tax under the alternative regime. And if that number was $100 or less, there's no minimum tax because you're paying enough regular tax. If under that alternative regime, the number came in at, for example, $105, that delta, that increase over the base regular tax would be paid as an alternative tax. And that $5 that was paid in any given year, the good news is at least if you paid it, you could try to claim it back in the following 7 years. It's almost akin to an anti-deferral tax by making sure that you paid enough tax in a certain year, but you did get to claim it back in the following 7 years. And the way that you would be able to claim it back, if you could, is if in those following 7 years, when you do that normal traditional calculation and the alternative calculation, when you compared the two, in any year, if your regular income tax, the $100, was greater than your alternative tax, let's say $80, that delta, you'd be able to use the credit of alternative tax that you'd pay in a future year. So it's something that's been around. What is changing? So you're right, it came out in budget 2023. We did see draft legislation in August. We haven't seen final legislation, but the feeling is that the draft legislation that we've seen is going to be the final legislation. And what has changed, there's a few different things that have changed. So number one, the computation of the base has changed. When the base, I mean the computation of income to which a tax rate has applied. So effectively, certain preferential items, such as the amount of capital gains, is more strongly included in the computation of the base. And certain deductions, which previously were completely allowed, very, much like income tax. A deduction example for interest expense was a 100% allowable. Certain deductions are only now half allowable in the computation of the base. So when you increase the additions to a stronger amount and you reduce the deductions to a lesser amount, the net result is that the base of which the tax rate is going to be applied for alternative purposes, it's going to increase. We've got the base increasing. The tax rate applied is increasing. So historically, for federal purposes, the federal rate for minimum tax was 15%. That's now increasing to 20.5%, which is quite significant. And of course, there's provincial as well, but I'll stick to federal for now. So the rate is increasing. And the third change, so first change, the actual amount at which we computed on, the rate is changing, but also the third piece is that the exemption is increasing. Now, this is going to be good news to most Canadians. Historically, the first $40,000 of taxable income was not subject to alternative minimum tax. That number has now increased to $173,000, which means for Canadians who have income up to $173,000, they will not be subject to alternative minimum tax. Alternative minimum tax is effectively a tax on the wealthy, a tax on the rich. It's a tax for people who have over $173,000 of income in a given year. And just a couple other things I want to say before we move on is that alternative minimum tax applies to individuals, but not in the year of death, which is very, very important because we know that in Canada, the year of death, if you're passing assets to anybody other than your spouse, it can be a very taxable year. There can be a big tax event on death. So AMT does not result in the year of death. As well, certain trusts are subject to AMT. So typical family trusts that we use in people's lifetime, those are subject to AMT. But one other important point is that corporations right now are not subject to AMT. Maybe next year we'll be having this conversation and corporations will be subject to AMT, but right now, not for corporations. So what we're really talking about are individuals, not in the year of death. And we're talking about effectively trusts that are set up during the lifetime of individuals.
Okay. So obviously, the base has changed, it's higher, and sounds like this is not going to affect everyone. What group of taxpayers are going to be most affected by these changes?
Sure, that's an excellent question, and it's important for both individuals who, if they're on this watching this webinar, or advisors who consult individuals, are thinking about, am I affected? Will I be affected? Who's affected? Will my client be affected? So certain examples of people who will be affected. So number one, and something very important to talk about in a group like this, when we're talking about people who are philanthropic, is that for individuals who donated appreciated stock, very large amounts of appreciated stock, I often would say, I'm sure you say the same thing, a very efficient way of making a gift to charity is by donating appreciated stock. Historically, the gain within that stock, not taxed at all, and the donor still got their full donation receipt. So now for an individual who is donating appreciated stock, if they are at that threshold, if their income is high and they are using appreciated stock to make donations, what they may find is that whereas before there was absolutely no tax on the donation of that stock, when I say no tax, I mean no tax on the embedded gain, it's possible that there will be tax on that gain going forward. Again, the intricacies of the person's world, the nuances have to be looked at, but I would say that's not something that I wanted to mention for sure. But some other groups of individuals. So number one, if there are people who personally, realize, I would say, very preferential income on their personal tax return. So what that means is people who trigger capital gains personally, and I have some clients who are investors and they live off of their capital gains every year. That's what they're investing for. And every year they trigger, X hundreds of thousands to millions of dollars of gains each year. And that's the income that they want to live off of. Those people will definitely be affected by alternative minimum tax because the result of the AMT is that the tax on the capital gain rate, if you're subject to these rules, can increase by about 7 percentage points, which is it's about a 25% increase in the overall rate. So if you have lots of gains, if you're going to be having a liquidity event, so if you have a business, for example, or an asset with a very large gain that you're going to be selling, and people often ask, well, what does large mean? So, number one, you have to be over the $173,000 of taxable income to start. And then, once you're over it, technically it's going to hit. Where I start to get nervous is if the numbers are so large, like for example, if you have, a multi-million-dollar gain, for example, your AMT hit might be so large. I talked before about how you can carry the AMT forward and use it up in a future year. But if the AMT hit is so large, you may not be able to soak up that AMT that you paid. So people who have large gains, another couple examples of people who are going to be affected are employees who have received, I'll speak specifically about public company stock options. So many individuals who work for public companies receive stock options. They can be taxed very preferentially. They can, depending on some of the details, but it can be that when they exercise and then sell the stock, it's possible that the benefit from the stock can be taxed like a capital gain. Again, those people have to be very careful because the tax rate applied to their benefit may be changing. For example, I had one new client I was speaking to last week. These are big positions. He had a stock option pool of non-exercised but fully vested options that they're going to expire in 2024, and he knew for sure he was going to trigger them in 2024. The embedded gain in those options was about $10 million. Huge, big numbers. And from talking to him, I said to him, do you realize that if you wait and exercise in 2024, and I know you're going to exercise because there's a gain, it might cost you an additional $700,000 to exercise those options in 2024. Oh my goodness. And then we started thinking about, okay, does it make sense to prepay the tax in 2023 at the old rates? Of course, dovetailing it, tying it in with his philanthropy to make sure we time up his philanthropy in 2023 versus having, you know, a much larger tax amount that hit in 2020, a much larger amount hit in 2024. So those are, and then, sorry, those are certain buckets of people. Again, not a traditional, typical Canadian, but certainly people who have, you know, very large positions or with large gains, I should say, within them. But another one that sometimes people often don't think about is departure tax. So in Canada, when we leave the country, if we decide to emigrate for tax purposes, and we decide to move to another country, in Canada, we pay an exit tax on the way out the door called a departure tax. And if you are someone, or you know someone who's planning on leaving in 2024 or later, their departure tax, their gains tax is going to hit in that year. And so I've been working with some clients who know that they're going to leave then, and they know that their gains tax is going to hit then. They're doing what they can to perhaps pay earlier the tax in 2023 so that they won't pay any AMT. I'm never a fan of prepaying tax, but if we can prepay it at a much lower rate and don't have to pay the AMT on the way out the door, because by the way, that person who's leaving the country, they're never going to get their departure tax back. They're gone. They're never going to be able to soak it up. So I would say those are, sorry, one other one comes to mind. I have lots of examples, but one other one comes to mind is that people who also on their personal tax return, if they claim large amounts of expenses, so if they have large interest deductions on their personal tax return, large fees paid to wealth managers on their personal tax return, again, you have to be over the $173,000 of taxable income. But if you have large deductions, historically, those were always allowed 100% for purposes of income tax and alternative tax. Now it's only going to be allowed 50% for alternative purposes. The result might be that when it comes time to file your tax return, you think, you know, my tax rate used to be this, but all of a sudden my tax rate is now higher. You know, it's true. This is a result. We're in a world of higher taxes.
Wow, lots of
Didn't ruin your day, Tina.
consequences. And the departure tax example was very interesting, and the fact that these people can never recoup. So the 7-year carry forward is not going to work for them. Yeah. Very interesting. So how will these changes affect tax savings from charitable donations?
That's a very that's a very important question. So we talked about the example. We talked about the example of the person who donates public company stock. And you know, one client that comes to mind is a person who has a whole bunch of REIT units, for example, REIT units that have a very high fair market value and a very low cost base. And as some people may know, REIT units often do a return of capital, and the cost base gets driven lower and lower and lower. So those would have been a perfect example of an asset to contribute or to donate to a charity, because we wouldn't have to pay, the client wouldn't have to pay any tax on the appreciation in the stock, and they would still get a full donation receipt. So the answer is that person should still, in 2024 and going forward, they should still donate the appreciated stock. The issue is, though, is that they may find at the end of the day that on their tax return, they ultimately owe more taxes or didn't get as much bang for their buck, if you will, from a tax efficiency point of view from the donation. So I do expect that for certain individuals, depending on how they're donating, and what they're donating, and even if they're donating at all, what may happen is that they may owe, I'll say a few more dollars, that can be anything from a few dollars to thousands to millions of dollars. Ultimately, it may reduce the benefit of the tax shield, I'll say, effectively. Yeah, so I think that's very important, and that's true too, even for the person who's donating cash. If a person, and that might impact many, I'll say, many wealthy retirees. I mean, many wealthy retirees or wealthy investors in Canada structure their portfolios to realize tax preferential items such as dividend income, capital gain income, and the combination of tax preferential items with deductions, whether it's a cash gift or a stock gift, those two together will increase the likelihood and magnitude of alternative minimum tax. And the important point here to say is that it might still be, there might still be no change to a specific person's way of giving or what they're giving or how of giving. The end result is we're in the world of higher taxation. This is probably the most convoluted way to raise taxes. It's extremely difficult to explain and think about, and it's almost impossible to give a straight answer because it's such a nuanced calculation. But effectively, that's the result of this. I'm going to think of actually two extreme examples of donors and how it affects them. I have one lovely client, a lottery winner. May we all be lottery winners, but it's not as common. And in her situation, she's a lottery winner, and her intention is that she wants to earn, she's going to earn investment income from the portfolio, and she wants to pay absolutely the least amount of taxes possible. And so every year I determine, okay, how much do you have to give away? And the dollars are, they're big dollars. They're tens and tens and tens of millions that she won. But the interesting piece was that through donation planning, we were able to get her overall tax paid on her investment income down to $30,000. Going forward, it's going to creep up to about $80,000. I mean, she's still a very happy client and customer and person, but it just goes to show you that changing nothing as a result of the changes to alternative minimum tax, her overall tax is going to increase. And often, I'll think of another client whose intention is to give away everything, right? It's absolutely beautiful. She's a very wealthy person, and her intention is to give it all away. So what I've said to her is, look, at the end of the day, you can still absolutely give it all away, but we do have to be cognizant of, we may have to save some of the money that we're giving all away to send to the Canada Revenue Agency, to send for taxes, because previously we could send it all away, make unlimited donations of appreciated stock. We'd end up, we'd be able to manage the tax as much as possible. Now the message is, well, you can still give it all away, but a little bit more of it's going to be directed to the government versus directed directly to the charity.
Maybe that will motivate people to give more during their lifetime as well.
Yeah, absolutely. Absolutely.
Okay, so we talked about donation of appreciated securities. Another strategy that is used for charitable donations is using life insurance policies to fund a large charitable gift on death. So in this strategy, the owner would be the donor would be the owner and payer for the policy. The charity would be the beneficiary of the policy. And when the donor passes away, the death benefit would be a charitable donation that could be used to offset taxes for the estate of the donor. It could be used in the gradual rate estate to reduce taxes as well. So how will this strategy be affected by the new AMT rules?
That's a great question. So, and you're absolutely right. Life insurance can be a beautiful way to make a very meaningful gift to a charity. And I would say it depends on a few different things. So in the situation that you described, that's an individual who was perhaps using a life insurance policy for the purpose of funding a donation to deal with a death tax, right? To deal with death tax.
Yeah.
And many people do. In that specific situation, there probably won't be any change whatsoever because alternative minimum tax will not hit in the year of death. So that's the good news. But I think it's important to discuss another couple of alternatives with life insurance. So many people, for example, myself included, I'm proud to say this, I have a gift that I make every year that I wanted to endow and that will live on in perpetuity. One day, may I live to 120, but one day when I'm not here, I want it to live on forever. So in this specific case, I took out a life insurance policy. I fund a life insurance policy. The owner, hopefully I don't get this wrong, but the owner and the beneficiary are actually the charitable organization. And each year I get for the cost of the premiums that I pay, I get a donation receipt to do that. And so that might impact, someone like myself from an AMT point of view, because under the new AMT rules, that premium that I pay where I get the donation receipt, akin to making like a cash donation, I will only be allowed 50% of that deduction for the purposes of computing AMT. But at the same time, I'm still very, I don't think that I would have changed anything that I did. It's still, and in this case, I don't think that I'll necessarily be hit with AMT. Maybe I will. I don't know. Maybe this is like the shoemaker's children who doesn't have shoes, but we'll see. But it still was a very meaningful way, for me to fund an endowed gift that way I know that my gift will live on, long after myself. So that's a specific situation where I decided I wasn't doing it for purposes of mitigating tax on death, which is akin to what you were saying, which should not be impacted by AMT. But I wanted to get the benefit of the tax receipt from the policy premium today. It'll be paid up soon. I'm almost done. And then when I pass away, there will be a gift left to the organization.
Exactly. And that's a great strategy too. And as we all know, you either get the tax credits during your lifetime or on death. You cannot get it both ways.
It's one or the other. Yeah.
Exactly. So another, charitable giving strategy that involves life insurance, which is less used but can be very attractive, is donating an existing life insurance policy. So there are people who have life insurance policies that they bought years ago. These are whole life policies with cash values, dividends, everything, and they don't need them anymore. So the initial purpose has been served. Usually the donor is entitled to claim a tax credit for the fair market value of the policy when they donated to charity. And the fair market value in some circumstances could be substantially higher than the cash surrender value of the policy. How will these types of donations be affected by the new AMT rules?
That is a great question. And we do see in our practice, as you mentioned, a client may have taken out a life insurance policy. Perhaps when they took out the policy, they had, they were funding potential tax on death or some other liability that was going to come from. And perhaps that issue has disappeared and they feel that they don't need that liquidity anymore. It's always great, especially when we have, especially when it's a paid up policy well, I guess in a paid up policy, there wouldn't be any more payments, but you definitely don't want to terminate or cancel the policy, and people do choose to donate that policy. So in the case that you described, I think that would be akin to giving a cash gift, in the sense that the donor would get a donation receipt for the amount donated, and if the fair market value of the policy, and you're right, the actuaries would have to look at what the fair market value is of the policy at that time. But again, to the extent that that person has preferential income on their tax return from their other income sources, the benefit, the tax efficiency benefit of making that gift might be reduced. That's what the answer is. There still will absolutely be a benefit, but the benefit may not be as large in 2024 and forward.
Mm-hmm. Okay, and another strategy involving life insurance, which again is not very common, but it has actually been increasing in use in recent years. It's the immediate financing arrangement where individuals use their life insurance policy as collateral for a loan, and this could be done on a personal level or on a corporate level. So for regular tax purposes, the borrower can deduct the interest expenses of that loan, any guarantee fees and collateral insurance deduction when the policy is personally owned, and could use those deductions to offset other sources of income. How will this particular type of strategy be affected by the new AMT rules?
That's a great question. So I think the impact could be even more magnified under the new AMT rules, because now we're talking about other deductions beyond just, for a charitable person, we're talking about deductions beyond charity. We're talking about interest deductions, the cost of pure insurance, other things like that. Those deductions for purposes of alternative minimum tax will be cut in half. And it might mean that the person's, their tax result, again, will be higher at the end of the year, and they have to prepare themselves for paying more tax at the end of the year, again, on a straight comparison between 2023 and 2024.
Mm-hmm. Okay. And my final question for you is, there are donors who may have had big liquidity events, they have big tax bills to pay in 2023, and they want to support several charities, but they cannot decide which charities exactly to give the money to. So for these types of donors, what would you recommend, and how can they give most tax effectively to support the charities that they want to support?
So that's a very important question, and I'm going to answer it and the answer is going to actually hit on a few different things. So where I think you're going with this, in the sense of the timing of donations, the timing of tax receipts, the timing of when we make a gift is so important from a tax point of view. So as you mentioned, if somebody's had a liquidity event, or 2023 is a very high tax year, then from the point of view of making a gift, we always want to time the giving of the gift, or the receipt, the tax receipt of giving the money away, to the year in which, sorry, my phone's ringing, to the year in which we want to time the timing of the receipt to the year in which the income was there. There's nothing worse than when somebody calls me up, a new client, and says, "Oh, I sold my business 3 years ago and I want to make my $1 million donation now." And I'm thinking, like, oh my goodness, we should have been thinking about, and again, I wouldn't have been their advisor, but we should have been thinking about their donation receipt in the same year. So often what we do is, when we have clients who have a very large amount of taxable income in a given year, and this will be true in 2023 and forward, even under AMT rules, is that we talk about foundations or donor advised funds. And it's really the concept of being able to take assets, take investments, take money today, put it into a vehicle that allows you to receive your tax receipt today. And you are giving up the rights to the money. You're giving up the rights to the investment income. The money is going to grow tax-free in some sort of, tax-free vehicle, because this money is earmarked for charity. And then at a later point in time, that money can be given away. There are certain rules. If it's a foundation, perhaps you have to give away 5% of the value each year. Usually in the world of a donor advised fund, because it's really a pooled fund, you're often not required to give away a certain amount, because there's enough people giving away more that the balances work out. But these are both very commonly used vehicles where timing is a key consideration for tax planning with donations, because we want to make sure that we get the receipt in a certain year, even though you may not have any outstanding pledges, or you haven't decided where the money is going to go, or you haven't decided which program at Princess Margaret you wanted to give it to, even though you're going to give it to Princess Margaret. So the important point is that money can go into these donor advised funds. And a donor advised fund, just for people who don't know, I keep using that term. So foundations so a private foundation, so I can have the Spinner Family Foundation. That is a vehicle that, if it's blessed by the Canada Revenue Agency, I can put money in. I'll get a donation receipt for putting money in, and then I can give it to Canadian registered charities. And even though it's the Spinner Family Foundation, a little known fact, maybe it's not so little known, is that you can go on Google and the charity's listing and see, oh, this is how much money Ali's put in, and this is how much money she's giving to Princess Margaret each year. So I find that many clients like the use of a donor advised fund, and there's many donor advised fund. Most financial institutions have them. I'm not sure if Princess Margaret has one or not, but certain charities have one as well. But there's many community ones as well where you can put money in, again, to time the timing of the receipt, so that the money can be directed out at a later point in time. So that's also very important to talk about. And just before we move on to the questions, is that the reason that donor advised funds are also getting so much airtime right now is that as we come to the close of 2023, if there are people who have a philanthropic intent and they know that they want to make donations, or they know that they have outstanding pledges and they want to make sure that those pledges, that they get the best tax efficient bang for their buck. As we have many clients who are putting money into donor advised funds in 2023 to make sure that those donation receipts and the tax benefits are subject to the old rules, the 2023 and prior rules, not the new AMT. The one caveat is that you have to make sure that in 2023, you can soak up the full amount of the donation receipt. So we don't want people putting millions of dollars into their donor advised fund if they can't soak up the full amount of the donation tax credit, the receipt amount in 2023. It just means that, people can still do it. It just means that they're still going to be subject to some of the AMT tax changes in 2024 and beyond.
That's a very good point, because yes, you can carry forward your charitable donation tax credit for 5 years, but the carry forward amount will be subject to the new AMT rules starting January 1st, 2024. Yeah. I guess the biggest learning is that if you're a high income earner, or if you know donors or clients who are high income earners, who are philanthropic and have intention of making, big gifts to charities, make sure that you talk to your financial advisor, to your tax advisors ASAP before year end to start planning and get the best tax efficiency for your donations. Ali, it's been a pleasure as always talking with you. Thank you so much for your wise answers to all of my questions. I'm going to pass on the virtual podium to Jill Nelson so she can moderate the Q&A session. Jill,
thank you so much, Tina, and I echo your thanks both to Ali and to you. But please, nobody jump off the call, because now is the time we get to answer your questions. And there are several, which I'm delighted about. I'm going to start with one of my own, and it's a bit, I hope it won't be too controversial, but, with everything going on in the world these days, and the needs of charities and the needs of individual Canadians to be served by those charities, why now? Why is the federal government deciding to take this battle on? Yeah. I've heard of hundreds of people who have advocated for maybe at least a pause on this for people to, but it seems like very little time from the announcement of the budget measures to now.
Yeah.
Do you have any thoughts on that?
Great question. I'm not an economist, and I don't work at the Department of Finance, and I'm not here on behalf of the government. So the truth is, I really don't know. But what I can say is this, is that I have two things to say. Is number one, there's no question that governments around the world are looking to raise revenue, and they raise revenue through taxes. Why they chose to do it this way through alternative minimum tax, I don't know. It really, I know in the perspective of it's a good story, and then they can say, well, we're just taxing the very, very wealthy. Why it then affects charitable donations, which, the largest charitable donations are funded by the wealthiest Canadians. I don't know. The other comment I would have is that I've heard some past Department of Finance members saying that they think that these rules were intentional by the Department of Finance, but I strongly suspect that in government, it's that the person in this group here doesn't necessarily, I'm making things up, but doesn't necessarily talk to the people here. And yes, we know that the government also relies on charities to do lots of incredible, amazing work. We don't just rely on the government to do everything. We rely on charities to do the amazing work that they do. So I don't have an answer for you. I don't know, but yeah, other than I think that we're in a world of rising taxes, and I think we're going to continue to see taxes rising.
Oh dear. Tina.
So Jill, I agree with Ali. I don't know exactly either, but I think from a political perspective, wealthy people are always an easy target. They don't get much compassion from the entire population in terms of having to pay a lot of taxes. But at the same time, I'm not sure if the government had thought through all the implications of this change and the impact that it would have on the charitable sector. Because if it indeed reduces donations to the charitable sector, then the government may have to step in and make up that difference. So, they make money on the one hand from, the extra revenue from the alternative minimum tax rules, but then they have to spend it on the other hand because the charitable sector is huge. It makes up about 10% of GDP in Canada. So it has to be supported by the government, and they cannot let the sector suffer. So that's my 2 cents.
Thank you. I think that's one of the beauties of our previous tax system, it still exists for a lot of people, is through donations, you can support the causes that matter to you rather than counting on the government to support those causes, because you don't know. This way you can add. Now, I want to get to our guests' questions, and you may have answered these during the presentation later, so just tell me that if it's so. The first question is the potential change regarding donated stock only applicable to the AMT calculation. In other words, if one's regular tax is greater than the AMT, will the advantages of donating appreciated stock still be available?
The answer is absolutely, absolutely. And I would still say that donating appreciated stock is still extremely tax efficient. It might mean that as a donor, you have to pay a little bit of tax on the donation of that stock. And when I say a little bit of tax, you're still going to have the donation receipt to wipe out the tax. I guess you think about it as wiping out other tax and other income. So even if you are subject to the AMT, this is still going to be a really solid, very efficient way of making a gift. But to answer the question, yes, the potential change for donated stock it's only with respect to AMT. Nothing else has changed.
Super. Tina, do you want to add to that, or that's
totally correct? I think it still makes a lot of sense to donate appreciated stocks, but your total tax savings from your charitable donation tax credit and elimination of capital gains tax could be lower if you're in a high income tax bracket and you get caught in the AMT calculations.
Absolutely. And from what you've said, that high income tax bracket is people who are making more than 173,000 taxable income. So I think that's a really important thing for our guests to remember. This is certainly not applying to everyone. And Ali, the next question is for you. You mentioned trusts are not subject to AMT. Do these include alter ego and joint partner trusts? And I think you said maybe some are.
Some trusts are absolutely subject to AMT. So certainly, so it's interesting because and sorry, I feel like I'm off my game on this question, but I would expect on the alter ego trusts and joint partner trusts that all of the income in those trusts comes out anyway to the individual. Although there can be a funny result that I'd have to think through if there's a deduction of expenses. But I will definitely say that certain, like inter vivos trusts, family trusts, absolutely are subject to AMT. And I would expect alter ego trusts and joint partner trusts also to be subject to AMT. Certainly graduated rate estates, which are trusts, are not, it's not that they're not subject to AMT. It's a question of whether or not they get the exemption. Sorry, that's the key, is that I think the starting point is that AMT, yes, the question is whether or not they get the AMT exemption. Now, so certainly the family trusts will not get the AMT exemption. And I know, for example, there's a big, not I should say big, but there's a challenge also with, which is way too technical for this, but testamentary spousal trusts that won't get the AMT exemption, and there can be some really funny results with trusts. So I do think that if you have trusts in place, it's important to speak to the accountant to have a look at that trust and determine if there will be an impact from AMT for sure.
Yeah, really good point. There's also a question that I think you answered. Someone has asked also if one has a charitable gift program and donates through this, does AMT apply? I think this is about donor advised funds, right?
I assume so. So it says if one has a charitable gift program. So number one, if the money is already in the fund or the foundation, there's no concern. You've already gotten the receipt. The money that's there can be sent to charity. There's no concern. By all means, go ahead and grant that money away. On the money going in to the charitable gift program, or the money going into the donor advised fund or to the foundation, this 100% absolutely can apply. It's no different than giving the money directly to Princess Margaret. The rules around AMT absolutely would apply on the money going in.
Ina, do you want to amplify that at all?
No, I think Ali answered it very well. It's all a matter of whether you're talking about granting from your donor advised fund, which is not going to be affected because the money is already there. You already received the tax credits for it. Or if you're talking about new donations, which then would be affected, starting 2024.
For sure. So they would be affected next year. So if people can soak it up, as you've described, Alex, might want to make donations this year to fill their charitable, their donor advised fund, so that they get the advantages this year, and next year they can just keep giving. We look for sustained support over time, and we're certainly hoping people will be able to continue funding that. As you said, Ali, when it comes to the Princess Margaret, we're in the long game for cancer research, and research can take a long time. It's very expensive, but it has so much impact. So we certainly hope people will keep giving. A similar related question, how much will changes to AMT affect when one should set up a family charitable foundation?
So that's a great question. So the question of setting up a family charitable foundation, I would be of the view that I guess the question is, if you have the chance to set it up in 2023, and you know that if you were to otherwise wait, you would get stuck in this world of AMT. And if you can soak up the full donation receipt now, I would say, sure, go for it in 2023. But what I would often find with a family charitable foundation is that yes, there are tax benefits to doing so, but there's also a whole host of other reasons to opening up charitable foundations or charitable funds. And, even though I am a tax and estate planning person, I always look at things with my tax lens on. I also make sure that tax doesn't drive the bus. The only time that tax would drive the bus is if you're going to do something in 2024 and we could do it in 2023 and save a whole heck of a lot of money. Let's do it in 2023. Otherwise, I don't let tax drive the bus. And what I mean by that is that I don't think that AMT would affect the decision of when to open the charitable foundation and when to put the funds in. Sure, if I had a client and I knew that they had really preferential income and a huge gain in a certain year, but they were going to have a whole bunch of different types of income in a different year, I might say, okay, let's hold off on making that big gift to the foundation until the following year. But I find that in discussion with my clients, unless we're really timing a gift to a liquidity event or something else special, I would say people love foundations for all of the other things that come along with it, is, the ability to work with their families and deciding gifts and evaluating programs, all of the, I'll call it all of the non-tax, non-technical reasons that come along with it. Many wealthy families use it as a way to engage family members in financial discussions. Parents often use it as a way to teach their children about the goals and values of the family, which I think is 100 times more important than tax. Yes, tax savings is important. Tax is also not the end of the world. Like, we need to pay some tax. We need to have roads and all the. I'll leave my political commentary for another day. But it's important to recognize that it's not just tax that drives the time. And when opening up a family foundation, yes, there is some cost associated with it, and there's an ongoing annual maintenance cost, of course. But at the same time, the benefits and when I say the formality, it doesn't have to be formal, but many clients love using it in a formal way to have family discussions as part of what I call the wealth transfer, wealth stewardship discussion. It's a very nice way to enter into that in a wealthy family, to engage other family members that perhaps aren't really interested in learning about stocks and bonds and whatever it is, but the family can use to pass their goals and values on to the generation through the philanthropic discussion.
And, with regards to family foundations, definitely, all of the points that you covered, Ali, apply. They do require a lot of compliance and, having minutes for the boards, and they're not totally easy to manage. For those people who want a much easier solution, donor advised funds make most sense. You can achieve all of those, transfer family values, having those discussions with the donor advised fund as well, except that you don't have to do all of that, tax filing compliance work. That will be done for you. The other big benefit is that with a donor advised fund, if you want to leave money to multiple charities, you can do it through instructions with the donor advised funds, and then just put the donor advised fund as the beneficiary, the single charitable beneficiary in your will, and that will make life a lot easier for your executor. I had heard recently a lawyer had advised his client, who was talking to me, not to leave any gift for charities in your will because it will make it tough for the executor. I think that's a really bad, advice. I think it makes a lot of sense to make charitable gifts, but I can see from the executor point of view, if there are 30 charities involved, it would be a horrendous task. So the donor advised fund would come in handy from that perspective. But having said that, from a timing perspective, if you know what charity you want to support, let's say, you love Princess Margaret, you want to support their research, there's no reason to have a donor advised fund. Give the money to the charity right away. Absolutely. If you have not made up your mind, you have a big tax issue, you need the tax receipt now, and you need time to decide, then absolutely, you need to set up a donor advised fund, you need to set up a family foundation. But for those people who know who they want to give to, there's absolutely no need for donor advised funds.
And Tina, to your point, I say that usually about 9 out of 10 clients, when I have the discussion, when I say convince, it's not for me to decide, but I'm able to soft convince that they should use the donor advised fund route than the foundation, because for the reasons that you described. And just to highlight, when you mentioned that it's so much easier for the executor when dealing with just leaving a gift to the donor advised fund, I just wanted to highlight, everyone should keep in mind, all the money can still go exactly where you want it to go and fund those various charities, but the executor only has to wait for one receipt, as opposed to sending money to all the different charities and having to wait for all the receipts and dealing with the different charities. It can be a very efficient way of just directing the funds, getting the receipt, and then being able to have that donor advised fund disperse the money exactly as you set out. It is donor advised, so they take their advice from the donor. That can be a very, very efficient way of giving.
Terrific. Thank you. That was obviously an excellent question too. And then here's a question that makes my heart sing. PMH is one of 2 recipients of my entire estate. Do I need to advise them before my death? And I'm going to answer that one because I'm with PMH. You do not have to advise the charities before your death. We love it if you do, because then we can show you what kind of an impact your gift is going to have. We can thank you in person. We do not ask you for more or get, nudgy. We're just grateful and welcome and treat you as part of the family, really. So I hope you will, but that is certainly up to you. We have a lovely recognition program. We have a lovely program of events for people who have told us they've promised a gift in their will. So that would be fantastic. And I have one more question, and we're close to time, as you can tell, because my alarm went off. But if you can answer this quickly, does your answer for trusts also apply for express trusts? Bracket endowment funds for a nonprofit, as an example.
So I know exactly why this question is coming. So the answer is no, and I'll explain why in a second, but I know why this is coming is for those of us who work in the philanthropic space, there's been so much red tape and nonsense with respect to compliance and filing requirements for a whole bunch of different things. So let's come back to first principles for a second. We're talking about tax, and the good news is that nonprofits or charities are non-taxable entities. So while they may have to file a trust return, it's really an information-only return. There wouldn't be any tax charged, so don't worry about it. I'm hoping that there's also going to be a change for this person. You're welcome to give me a shout after, because I think I know where you're going with the question. I'm hoping that that's not going to have to happen, and you're not going to have to file trust returns for all of those. But just remember, a not-for-profit or a charity doesn't pay tax. So yes, while these new rules are there and you have to file perhaps a T3 trust return, it's really for information purposes only. It's not going to result in any tax owing by the organization, which is a good thing.
Super. So I get a couple of minutes to close, and thank you both for your expertise. I could tell in your answers something I already know, which is that you are both experts in business succession and in family succession. You're looking at the long term, you're looking at generational impact. And I think that's very, very special in an advisor, not just to be looking at the pot of money and, you're thinking about what people can do currently in their lives and as a legacy. And I know that you have given these talks and do these talks for many charities. You're very, very supportive of our communities by supporting charities. So I thank you for that. Also, there was one question about whether Ali's expertise includes the US and Canada, and I know for a fact it does. So she's super. And I have to say that when I win the lottery, I'll be coming to you two for help.
Here we go.
I don't have any problems with the AMT, I can tell you, but it will be great when I win the lottery for sure. And for all of you who attended, who are making our world better through your donations, through your fundraising, through your advisory activities, thank you for joining us today. We will be sending out this recording, and we will also be sending an article on the AMT from Tina, a special advance copy of an article that's going to come out shortly. So look for that in your mailboxes. And thank you. I hope you have a lovely day.